interest rate decoupling. We're going to ask this question to Francesco Castelli of Banor Capital, our fixed income expert from London. Welcome, Francesco.
Thank you, Marcello. Thank you for having me.
So,
yes,
Francesco,
the coupling.
Yes, sure. What has been going on in the interest rate environment?
Yeah, the coupling is really the right word. It's for a couple of years, we had US rates and European rates moving in tandem, a lot of correlation. For the first time in 2 years, we've seen a big decoupling. US rates are moving up, and this has generated a negative performance in US bonds over the last month, whereas European rates have remained stable, generating a positive performance for European bonds.
Okay, and why is this happening all of a sudden, if we can say that?
Yeah, I think we realized that there's a big divergence between growth in the US and growth in Europe. The Federal Reserve cut rates by 0.5 point, which was a big surprise. But then we realized that US growth is not that bad. And maybe it's going to even be helped by support for the Chinese government. The Chinese government is supporting the economy, and this is going to help the US in sustaining global growth. On the other side, Lagarde in Europe revealed at the latest meeting that growth expectations in Europe are not as strong as the ECB was mentioning in September. So growth expectations in Europe are a notch down, unfortunately. Okay. And this is so also you can see the result in rates we expect at the end of the easing cycle. That's the 2025, end of 2025, as you can see in the chart. In the US, we were expecting the Federal Reserve to go below 3%. Now we expect 3.30. In Europe, we remain as market participants firmly convinced that rates will need to dip below 2% to support the European growth.
Interesting. If we have a look at the FX markets, what's happening here?
Yeah, the differential in rates, you can see that's the orange line in the chart, is a driver of the FX market historically. And this year has been really a textbook case, because you can see that while we were waiting for the cut from the Federal Reserve, this differential compressed, so the chart moved up, and this pushed the euro dollar up, so dollar weakness. It's very interesting because immediately after the Federal Reserve decided to cut rates, we also realized that growth in the US was not that bad. And then the rate differential went wider, so moved down, and euro dollar moved down as well. So the US dollar is now appreciating in response to stronger growth and higher rates.
And a final word on European spreads.
Yeah, European spreads, as you can see, have moved down a lot over the last year. So European credit is a bit less attractive. On the other side, as you can see from this historical chart, especially when you look at investment grade, so the higher quality part of the market, spreads are not particularly low. We've been there before. Actually, European spreads are exactly in line with the median spread. So 0.5% of the time they will be higher, half of the time they will be lower. Exactly on the median. High spread, the lower quality part of the market, instead, they are starting to be a bit tighter. And so, as a general recommendation in this period, we would be a bit more cautious on the high yield component at this stage.
Perfect. We thank you very much again, Banor Capital, and in the person of Francesco Castelli, Head of Credit and Fixed Income. We remind you at Mercury Partners Academy, I'm Marcello Zanardo, CEO and founder, that we have Everything for you every day of the week, as you can see. Follow on our socials and keep following all our guests like Francesco and Banor Capital and all the other to be informed about fixed income and equity market. Join our internship and kickstart your career, because we got a lot of relationship with firms like Banor and many others. All the best. Thank you from me and thank you from Francesco. Bye-bye.
See you soon. Bye.